Can I just quote an article you wrote a couple of years ago about this, where you said, what were the sources of this imaginary wealth? First, spreads on credit that took no account of default probabilities. Second, unrealised mark-to-market profits on the trading book. Third, profits conjured up by taking the present value of streams of income and stretching them into the future. And then talked about this non-existent wealth being paid out in cash to employees because they had no measure of cash flow to tell them they were idiots. And you then talked about accounts that have become misleading to the point of treachery. Can we deal with the problem of pay without dealing with this problem of how the current accounting system creates fictional money?
It's the problem really that I was referring to in that article, which is now quite a long time ago, I think, was the issue that bankers don't think about cash in the same way as other businesses. Businesses know that even if they're unprofitable for a while, they're okay as long as they can get some cash in. But if they run out of cash, they're bust. Bankers live in a huge pool of liquidity, and they can always get money from other banks. So effectively what was happening was that, if you wanted to pay out a very large bonus pool for whatever reason, the bankers may have asked themselves what their shareholders would think about it. The bankers may have asked themselves whether it would look good in the accounts. They might have, even for a nanosecond, thought about the fairness issue, probably not for long. But they didn't ask about where they get the money, because they can get it in the market. And you just go out there and there it is. It's flowing around, and we'll give some to you and some to you, some to you. Now, this is going to be harder. I mean, if bankers were fooled by their own accounts, and I think to some extent they were, one of the things that particularly got my goat was this thing on very, very long-term derivatives. One reason for the explosion of the derivative business was that it was so profitable for bankers to sell them. Because if you sold a derivative to a client, and it lasted for, say, 20 years, and to a pension fund, for example, or even 50 years, the client would be paying a small fee every year to service that derivative. What the bankers do is to roll up those 50 years of fees, unpaid, into the first year, and they take half of it. And then the derivative goes into a drawer. So, this is where part of the fictional money came from.
Sorry. I want to sort of pursue this.
Yes.
For a commission like ours, which is concerned with culture and standards, what I'm really asking is, should it be an important concern of ours that if we want to change culture, we ought to look at the accounting standards, or think about exactly what you just described? Because, for example, we took evidence, part of the commission, on these interest rate swaps that are being sold to businesses. Precisely the same phenomenon was taking place there, which is future profits are all booked on day one for a product that may have a very long time scale, and this creates this capacity to pay yourself huge bonuses out of money that may never come about to the organisation. Can you really change pay just by thinking about it in fairness, or do you have to take on this other end of the telescope too?
Well, there's the accounting profession now requires all sorts of things to be present valued and put in the books as a charge or a profit on day one, if the stream of income is held to be certain. And the stream of income on a derivatives transaction over a long time with a solvent pension fund is held to be certain. I mean, the bank will get the money in, but it'll just take all the people who are being paid today will be dead by the time the last instalment comes. There is hope for some accounting standards to change. One of the most ludicrous standards which came from the US has recently been changed, which was the thing which threw the bank's accounts during the crisis, threw up huge profits. I'm just trying to think of a way of explaining it simply. It's so crazy. The idea was this: if one bank has a large exposure to another bank, say a good bank has a large exposure to bad bank's credit rating is cut. So bad bank now becomes worse bank. Good bank takes a loss on its exposure to bad bank, now worse bank, because to show that there has been some deterioration in the credit. There's more risk of not getting repaid. Perfectly fair. The American accountant said, yes, but this is unbalanced because we have only one entry. We only have one side of the entry here. So if there's a loss for good bank, there must be a profit for worse bank, because otherwise the books don't balance. So banks that were having their debt downgraded were showing accounting profits. Of course, there was no cash involved. Huge numbers. I wonder if the boards understood this. I mean, it's completely insane. Because, of course, the truth of the matter was that if you had a world where there were just two agents, and one was creditworthy and the other one wasn't creditworthy, and the less creditworthy one got even less creditworthy, there has been a real loss of value in the system. There has been a real loss, and not a transfer of wealth from one to the other. And I don't know how this ever came about, but it was put in place in about 2004 and has just been removed. It's a piece of insanity. So there is hope. They do sometimes see sense.
The point I'm driving at is we mustn't allow the complexity of accounting to disguise what in the end is a very simple point, which is that unless the money is real, all that you have is a license for people to loot the company.
Yes.
Rather than operate on the basis which a non-financial company would operate on, such as the sort of black country engineering companies that I represent, which is you might get a bonus if you're doing really well that year, but if you're not, you shouldn't, and each business has to live according to its means. I do want to come back to you, but I think Nigel Lawson wants to come in on this.
May I just say before Nigel comes in that I think one of the difficulties is that the boards of directors of the bank may not have understood that the money wasn't really there.
It's a fundamental point.
It is a pretty fundamental point, and it's shaming to have to say it in Portfolio's house.
You want me to?
Yeah, Susan Kramer.
Very quickly, in answer to a question from Pat McFadden earlier, you said there is some hope for an improvement in accounting standards, and you gave as an example a particular bêtise which has been stopped.
Yes.
Do you think there should need to be further changes in accounting standards, and if so, what?
I think the most important thing is that users of accounts should understand what the accounts mean. And the accounting standards seem to me to have gone to a particular kind of intellectual purity that personally I disagree with, because I think it isn't. I think it's based on a fallacy, but certainly has made it more difficult for boards of directors to know how much money is there now. Either the accounting standards need to change, or the boards of directors need to be educated. The second is probably easier.
The first is probably more important.
Perhaps.
We may want further advice and help in that area, which we maybe would do outside this meeting. Susan Kramer.
This actually follows up on that point, because once I got over the shock of any suggestion that any banker who's gone through any training at all can't tell the difference between cash and accrual, I mean, it has to be willful blindness. But perhaps where were the auditors in all of this? And it seems to me that the auditors surely that must have had responsibility for bringing this to the attention of the board of directors and making it clear that how exactly they were sort of structuring their pay and on what degree of rock or sand. And is there a real question here about the role that auditors played, and do we need to act on it?
I don't believe that the bankers didn't understand the difference between cash and accrual. I do believe that the bank has thought that the availability of cash for their business would not become a problem. And so paying out accrual earnings, although to you and me a disgraceful practice, was something they thought would not put the business in danger. I don't know what contact goes on with, I mean, I do know that banks' audit committees are even more serious bodies than they used to be. They meet more frequently, they have more papers than they ever had. The difficulty, of course, is to see the big picture.
Your evidence has been extremely lucid, very valuable to the Commission, and we're very grateful to you for coming in this morning. Thank you very much.
Pleasure.